All right, guys. So today in this video, I'm basically going to cover monetary policy. Everything from the money market graph to how the Fed works to what they do. I'll get into demand for money a little bit, but I'm really going to focus more on the supply because that's really, in monetary policy, it's really all about the supply of money. So anyways, if you remember, Unit 6, fiscal policy, we spent a couple of weeks on that. Fiscal policy is all about the president and Congress changing either taxes or spending to close gaps in the economy, to close inflationary or recessionary gaps. Now, one of the big problems with fiscal policy is that, in a democracy, at least, the politicians are constantly worried about getting reelected. And so they might not always do what's best economically if it doesn't coincide with what's in their short-term, voting self-interest. And so monetary policy is another way that we may be able to fix some of those inflationary and recessionary gaps, and with not having the same kind of political pressure to always be cutting taxes and increasing spending to be making voters happy so that you can get reelected. That it's real easy to cut taxes for people, but it's pretty hard for politicians to raise them. It's really easy to increase government spending to create jobs and make people happy. It's pretty hard to cut government spending to make people happy. So monetary policy is another possible way that we can adjust our economy. So to start with, I'm going to start by drawing up here our graph of the money market. All right, so we've got our money market graph here where you can see that my y-axis is nominal interest rate. I abbreviated it NIR for nominal interest rate. That's because this is really like a unit 2 supply and demand graph. This is the supply and demand graph for M1. So when you go to borrow money, you have to pay interest. That's the price of borrowing money. The price of getting money is you pay interest. Or if you lend somebody money, the price that you get paid is you get paid interest. So interest is the price of money. So we've got nominal interest rate on the y-axis. Our x-axis has quantity of money. So a lot of times I put QM. You could put, I put Q sub M, but some professors just put QM together. And then really here I have S sub M for supply of money, demand of money. Some professors put MS, MD for money supply, money demand. Either way, it really works. It's just as long as we know what your supply curve is, what your demand curve is. Now, it's important that you understand when we talk about the demand for money, we're talking about the demand for M1. So what we're really asking here is, if you have money, do you want it to be M1 or do you want it to be some other interest earning asset? Typically, I'll refer to interest earning assets. I'll refer to them as M2, even though technically M1 is part of M2. I usually refer to it as M1 versus M2. When I say M1 versus M2, what I mean is M1 is cash or checking account balances, money that's ready to be spent. That's M1. M2 includes M1, but when I talk about M2, I'm usually referring to things like bonds, savings accounts, and CDs. Things that you put your money in to earn interest and you cannot spend. So that if you want to buy something, you can't buy it if it's in a bond, or if your money's in a CD, or if your money's in a savings account, you can't spend it. You've got to first, if it's a bond or a CD, you've got to sell it. If it's in a savings account, you got to transfer it, but you got to do something before you can spend it. So that's M1 versus interest earning assets. And that's really the trade-off in the demand for money. So that when interest rates are really high, then you're more likely to want to put your money in M2 because it's going to make money for you. But if interest rates are really low, then you're more likely to say, maybe I just want my money to be liquid. That means ready to be spent. So if we look at, for instance, let's say somebody has $10,000 And that $10,000 is, sitting in a checking account, right? Well, what would it take for that person to put it in their savings account? If your interest rate is like 0.5%, you're talking about that $10,000 is going to lead to $50 in interest over a whole year. So like, is it really worth it to have your money sitting in an account for a whole year if you have $10,000 to get 50 more? Maybe not. But if there was like a 10% interest rate, then if you put that money in a savings account, at the end of a year, your 10,000 would turn into 11,000. That would be totally worth it. So the higher the interest rate goes, the more incentive there is for people to want M2. The lower the interest rate goes, the more incentive you have to just keep it in M1. So like this happened to me a few years ago. I was getting ready to do a remodeling project on my house, and we took some money out of the bank. We refinanced the mortgage on our house, and we got about $90,000 out of the equity or the value of our house. And so that money was sitting in my checking account as we were getting ready to do this project where we were going to be remodeling our house and spending it all over the course of the next year. Well, I got a call from my bank, and they were like, "Hey, is Mr. Tweet there?" I'm like, "Yeah, this is Mr. Tweet. What can I do for you?" And they're like, "Oh, I'm calling from Chase Bank, and we're at, I want to know if, you got so much money in your checking account, you can move this money over to your savings account and you can collect interest on it, right?" The bank wants you to put that money in savings because you're less likely to spend it. You're more likely to keep it with them, and then they can loan it out and make money off of it, right? So I was talking on the phone to this guy, and at the time I was like, "Well, what's the interest rate on your savings account?" And the guy was like, "Oh, well, like right now it's like 0.25%. But it may go up to like 0.5% soon." And I was like, "So dude, you want me to take like, this money, $10,000 or so, and you want me to move it over to savings, and I can let it sit there for a full year and I can make 25 bucks off of it, or I can spend it on remodeling my house like I wanted?" And the guy was like, "Oh yeah, I guess that makes sense." But if the interest rate was hot, like 10%, I would have been like, I can remodel my house. I can wait a year to remodel my house. If the interest rate was 10%, I would have taken the whole 90,000 and put it in savings and let it sat there for a year so I could get 9,000 more dollars, maybe do a little bit nicer something to my house. So that's the trade-off for, that's really why the demand for money is downward sloping, right? It's all about this interest rate and how much interest you get from interest earning assets. Okay, so awesome. That's the demand for money. Supply of money is a vertical line. The supply of money is decided by this group called the Fed. It's 14 economists and former CEOs of banks, 14 leading economic and finance experts from the nation, generally people who've either excelled in the banking world for 30 years, or maybe people who've excelled in the economic academia world for 20 years or 30 years. So that you have the best PhD economists, the best CEOs of Goldman Sachs or Citibank or Bank of America, that once they kind of reach retirement, that the pinnacle of their career might be serving on this group called the Fed. 14 economic experts. They're nominated by the president, they're confirmed by the Senate, and then they do their own thing. They're insulated from politics. The Fed, their job is determine how much money we have in our economy. So our supply of money is a vertical line because it's not subject to market forces. There is no direct or indirect relationship here. They just decide how much money that we should have in our economy. They pick a number, and whatever they pick, that's what we get. So we have a vertical line for our supply of money. Now, where these two lines intersect, we have an equilibrium interest rate that you can see right here. This is a lowercase I sub e for equilibrium nominal interest rate. That equilibrium interest rate on our graph, this is sometimes called the general interest rate because there is no specific place where you could actually see this. It's an abstract idea. There is no specific loan where you can see what the general interest rate is. But things like home loans, right? Car loans, student loans, credit cards, business loans, all of those loans, they all have interest rates and they all tend to generally move up and down together. There's some slight exceptions, based on, some weird things that can happen between, long-term yields and short-term inflation rates and things like that. But in general, all of these loans, they have different interest rates, including different interest rates for different people based on your credit history or your income, or depending on how long the loan is for, whether it's a secured loan or not a secured loan. All of those factors turn into different interest rates for all of these different things. So that, not only do all of these things have different interest rates, but it's different interest rates for different people as well. But what happens is when the general interest rate changes, all of these interest rates tend to move the same direction, not the same degree. So like if interest rates go up, like a home loan might go up a little bit because it's over 30 years. So it's not going to change very much real fast compared to say like a credit card interest rate is going to change a lot faster. So like this one might go up by 2%. This one might go up by 0.5%, but they're both kind of going up and going down at the same time. Now, other interest rates that we have to consider as well are like when you buy a bond, there's an interest rate associated with that. In this instance, the consumer is the one who's getting the interest, not paying the interest. So up here, the consumer or business is paying the interest. Down here, the consumer or business is getting the interest. So like if we put our money into a bond or what's called a CD, a certificate of deposit, it's like a savings account that you're not allowed to take your money out of. Has a slightly higher interest rate. Savings account. Right? All of these down here, they have interest rates as well. And in general, businesses and consumers are the ones who are getting the interest here, right? Up here, they're the ones that are paying the interest, right? When we go to buy something or expand our business. So what we tend to see, right? Going back here to our money market graph. If the supply of money increases, right? If the supply of money increases, my nominal interest rate will fall. If my supply of money was to decrease to the left, nominal interest rates would go up. So the whole theory of monetary policy is if we can control the amount of money in our economy, and if we can adjust that amount of money, we can cause interest rates to go up or go down. And if you can control interest rates, what you can do is you can get people to move from one category to the next. So that what we see here on the bottom, bonds, CDs, savings accounts, these are places that people put their money to try to save and earn more money in the future. These are interest earning assets. Up here, we have things that are GDP, right? A house, a car, right? This is a good. Paying for college, that's a service. A credit card is usually used to buy goods and services. And then a business loan is used for investment to start a business or expand a business. So up here, we have consumption and investment. These are two parts of SIGIX. This is stuff that adds on to aggregate demand. Down here, we have financial transactions, bonds, CDs, savings accounts. So if we can change the interest rate, so let's say we make interest rates go down, right? If we make interest rates go down, right? If I've got money, that bond is not going to be as attractive because it's not going to pay me as much anymore because interest rates are lower. That CD, it's not going to be very attractive because interest rates are lower. Same thing with the savings account, right? However, right, if I wanted to get a loan to start a business, That's going to be a lot cheaper if interest rates go down. So if I had some money and I was like, how can I use this money to make more, right? Maybe instead of putting it into a bond, maybe I'm like, maybe I should start a business because I can get a business loan pretty cheap right now and bonds aren't paying anything. So if we lower interest rates, we make these less attractive. We make these things more attractive, right? Maybe instead of putting my money in a bond, maybe I'll buy another house and I can rent it out and I can make money that way. Maybe real estate then is where I'm going to go. And so now what we're seeing is more demand for houses, a good, aggregate demand increasing instead of a demand for bonds, which is not going to affect aggregate demand because it's a financial transaction. So if we lower interest rates, we get these things are less attractive. These things become more attractive. We get more aggregate demand. More aggregate demand means more real GDP. So we can close an inflationary gap and get to full employment. If we have an inflationary gap, we do the opposite. We drive up interest rates, right? The Fed lowers the money supply. That makes interest rates go up. When interest rates go up, that makes these things up top, it makes them less attractive, right? I was thinking of buying a house, but interest rates just went up by 1%. And so now that house, the monthly payment is going to be a lot higher, even if the price of the house didn't change. So it's more expensive to me, the buyer. So now I don't want that house so much anymore. Maybe instead I should take that money and instead of investing in a house, maybe I should take that money and I should buy a bond instead because the high interest rate is attractive. So what's happening is we're saying less aggregate demand, more financial transactions, more interest earning assets. So what you begin to see is that the Fed, by controlling the supply of money, controls interest rates. And by controlling interest rates, they can drive people to aggregate demand or away from aggregate demand. They can drive people towards things that are going to like lead to an increase in aggregate demand, or they can push them this way towards interest earning assets, and it's going to be a decrease to aggregate demand. And if we can shift aggregate demand, it's just like Unit 6. We can close recessionary and inflationary gaps. So you can imagine like one place where you would likely see this is like on a test question. It would probably start with aggregate supply, aggregate demand. Maybe you start off in full employment. Maybe then there's a shifter that causes you to shift to an inflationary gap or a recessionary gap, right? In Unit 6, the follow-up question might be like, what could the government do to close this gap, right? And that's about fiscal policy. Or in Unit 7, the follow-up question might be, draw a graph of the money market in the short run, and then show, explain what the Fed could do to close this gap and show it on your graph. So then you would be showing a shift of supply, changing the interest rate to close that inflationary or recessionary gap. So the next step for us, this is the what. Now we have to look at the how. How does the Fed actually do this, right? Monetary policy, the Fed changes the supply of money to change interest rates to shift aggregate demand. That's the theory of monetary policy. But now we're going to look at the how. How does the Fed shift the supply of money? That's the question. How does the Fed increase or decrease that supply of money? And that's what we're going to look at next. So it turns out there's 3 ways that the Fed can shift the supply of money. The first 2 don't happen very often. But the third one does happen a lot. So we're going to go through all 3. The first way that the Fed can shift the supply of money is that the Fed can change the reserve requirement. So how does changing the reserve requirement, how does that change the supply of money? Well, to understand how that changes the supply of money, it's going to require us to actually look at what money is and where it comes from. So typically at this point, I might ask who creates most of our money? And the answer that I usually get is the government, or sometimes students that have kind of moved ahead a little bit or have gone ahead, sometimes they'll say the Fed. that the government or the Fed. Now, what I showed you over here was that the Fed's one job is to control the money supply, right? And the Federal Reserve does play a very significant role in the creation of money. Right. Here's a dollar right here. Maybe you've never noticed this, right? It's a dollar. It says the United States on the front. It says the United States of America there on the back, right? But then if you look up here at the top, it says Federal Reserve note. It doesn't always said that, right? Our money only started saying that like in the 1930s, I think, when we switched from the gold standard to paper. That before the gold standard, before we had fiat, when we were on the gold standard, the Federal Reserve were not the ones responsible for making these. It was the Treasury Department that decided when to make more money, right? As the United States acquired more gold, it produced more paper. But then when we switched to that fiat system of fractional reserve banking with the Federal Reserve in charge, now the Federal Reserve decides when we make more of these, they tell the Treasury it's time to print more money. Now, sometimes that money is to replace existing money, sometimes it's new money, right? So the Federal Reserve, they're in charge of printing these. But the Federal Reserve doesn't make most of the money in our economy. In fact, most of the money in our economy is not created by the Fed, but it's created by banks. So we have to understand how banks create money in order for this to make sense. So in order for this to make sense, I'm going to go through like a little scenario with you, right? So let's say we've got someone, we'll call her Anne. All right. So Anne has $1,000, right? She's been, we're babysitting for months. She's saved up her babysitting money. Anne has $1,000 and she's going to go deposit it into the bank, right? So Anne has $1,000 cash, right? Anne's got $1,000 cash and she's going to deposit this into the bank. So Anne goes into the bank, she waits in line, she gets up to the teller, she hands them $1,000, they clickety-clackety-clickety, they rip off a little receipt and they hand it to Anne, who previously had a balance of $0 in her bank account, but now she's got a balance of $1,000 in her bank account and she walks out, right? Now, after Anne walks out of the bank, in walks Billy, all right? So we've got Billy here. All right. So Billy walks into the bank and he says, I need to speak to a loan officer, right? So what do you need to speak to a loan officer for? Billy says, I want to buy a car. And they said, all right, so you want to get a car loan. So we'll get an expert in car loans over here to talk to you, right? And the person says, all right, well, what's the car you want to be? And Billy says, I want to buy a car from my friend Carl, right? Carl's got this car. It's worth like $4,000, but he's willing to sell it to me for $1,000 because he's desperate, right? And so the bank doesn't normally make car loans like this. Usually it's for, new cars or maybe more expensive used cars, usually not like a situation like this, but whatever, right? The bank's like, all right, Billy, we will, right? We'll let you borrow $1,000. They give Billy a loan of $1,000. So they hand Billy a check or maybe even cash, probably a check for $1,000 made out to Carl so that Billy can go, and Billy goes and finds Carl and hands Carl the check and Carl hands him the car keys, right? Now, Carl, he takes this check or cash, whatever, it doesn't matter. He takes it to the bank. He waits his turn and he goes up to the teller and he says, I'd like to deposit $1,000 into the bank. And so he waits his turn. He eventually gets up there. They clickety-clackety-clickety, put the money, take the money from him, count it, put it in the drawer, rip off his little receipts. It has a deposit of $1,000, hands it to him, right? Carl has a $1,000 deposit and then he leaves. Now, the next day, Anne, Billy, and Carl, they're all in class together at school. And their economics teacher, Mr. Tweet, he has like no sense of decency. So Mr. Tweet just says, asking these random questions, right? He's like, hey, Anne, how much money do you have? And Anne says, right, I've got $1,000. Mr. Tweet says, prove it. So Anne takes out her cell phone and goes to the app for her bank account. And it says her account balance is $1,000, right? And then Mr. Tweet asks Carl and says, Carl, how much money do you have? And Carl says, I also have $1,000. And he pulls out his smartphone and goes to his app for his bank and shows his account balance of $1,000, right? So now, how much money exists in this economy? Is this M1? Does Ann have $1,000 of M1? Does Carl have $1,000 of M1? What do you think? The answer is this economy has $2,000 in it now. It had 1,000, but now it has 2,000. The bank created $1,000 because remember, M1 is cash and checking account balances. So in this instance right here, Ann's got $1,000 in her checking account. That's M1. Carl's got $1,000 in his account. That's M1. How did this happen? How did $1,000 turn into 2? The answer is with Billy, that when banks make loans, they create money. And so in this economy, we have $2,000 of M1 because of the loan that was made. So when we go to this graph right here, and we're looking at the supply of money, and we want to, we're looking at, how much quantity of money we have in our economy, we've got to factor in how much money that banks can make through loans in a fractional reserve banking system. So in order to do that, right, we have a tool that can help us. That tool is called a balance sheet. So a balance sheet is a thing that accountants use to judge how well businesses are doing financially, right? So they use this balance sheet to kind of help figure out whether a business is profitable or not. Now, I gave you guys an assignment a couple of days ago that involved a lot of balance sheets, and I know that might have been hard or whatever. I'm going to go over it next week with you guys on Wednesday, I think, on Zoom. I'll go over that worksheet with you guys. However, for a balance sheet, in order to understand kind of how they work, the basic idea is this half of the balance sheet over here should balance this half of the balance sheet over here. So this side and this side should be balanced so that if you have 100 on this side, you need 100 on this side, right? Or it could be 50 and 50 like that. As long as it's 100 on this side and 100 on that side, you're okay. If you subtract 10 from this side, then you've got to subtract 10 from this side, right? This is how balance sheets work. Now, obviously, not all businesses have all of their, like the two sides obviously, balance out 100%. I'll get there in a second. But the two sides of the balance sheet, on the one hand, we have what's called assets. Assets generally are things that a business owns or is owed. So owns or is owed. That's what goes on the asset side over here. So like this is like the things of value that the business has. The other side is liabilities, things that the business owes to others, including, customers or other businesses or whatever. So this is what they owe. This is what they own. If what they own is more valuable than what they owe, if this side is bigger, then you'd have a positive amount down here under what's called equity. Should rewrite that? It's a little bit messy. So if they have a positive amount under equity, that basically means that the business has been profitable and it's added to the owners, like it's made the owner wealthier. Equity is like the excess value of the business that you have, right? Equity can also be negative. So like if your liabilities are bigger than your assets, then you'd have a negative equity. And that means that you owe more than you own and you're kind of negative equity, or you're losing money, or you're upside down. Sometimes upside down or underwater. It's another phrase they use to describe having negative equity, upside down, underwater, something like that. In the red, that would be negative equity. In the black, that would mean positive equity. Those are all kind of phrases that are used in accounting or economics to describe this, right? So we've got a balance sheet here. In AP Econ, the only time you really use these balance sheets are when we have questions about banks, and it really shows how banks create money or how they can create money. That's what we use these balance sheets for. So up here, I've got, let me, can't really see it very well because the shadow. Basically, the first thing that the Federal Reserve, the first power that the Federal Reserve has is that they have the power to tell banks how much money they have to save when money is deposited. So when somebody comes into the bank and they deposit like, you know, $1,000, banks are not allowed to loan out the whole 1,000. They have to hold on to some of it. That's called required reserves. The Fed gets to set the level of required reserves. So the Fed can tell a bank, you have to hold on to 5% or 10% or 20% of the money that comes into your bank so that the bank can't create an infinite amount of money. It's now limited. So a real common level of required reserves, a real common level is 10%. So I have that in blue there. So 10% is a common level of required reserves. So let's say we have somebody who comes in to make a deposit of $1,000. First thing is bank deposits go on the liability side, because when you put your money in the bank, they owe it to you, right? It's your money. They're using it. They owe it to you. So when you make a deposit, that goes over here and we put the letters DD next to the deposit. The DD stands for demand deposit or deposits on demand. And basically it means that you deposit your money with the bank, but that you can demand it back whenever you want. So DD for demand deposits goes on the liability side. If we've got positive 1,000 over here, we've got to have positive 1,000 over here, right? So what happens when somebody deposits $1,000 in the bank? Well, the first thing is that they're going to take out the amount that's required reserves, and they're just going to hold on to that. So 10% of 1,000, that's 100. And I label it RR for required reserves. So we've got $100 of required reserves. Whatever's left over becomes excess reserves. Excess reserves are monies that banks do not have to hold on to if they don't want to. Now, some banks choose to hold excess reserves or extra reserves. They choose to hold those excess reserves so that they can, in case a customer comes in and wants some money back, they have some extra money that they can use to give them. So excess reserves, every bank is going to hold some excess reserves. At least most of the time, they're going to hold some excess reserves. So then that way, you know, they have money on hand to give to customers. They could give required reserves to customers if they had to and then make it up at the end of the day. But in general, most banks are going to hold on to a little bit of excess reserves, but not all of it. Typically, the other things that banks are going to do with those excess reserves is they're going to use them to buy bonds, or they're going to use them to make loans. So if they go to make a loan, right? If they buy a bond, that's fine. It doesn't do anything. But if they go to make a loan, I guess when they buy a bond as well, whenever they spend this money, whenever they send this money out of the bank, they're creating M1. So right now, this bank can potentially create $900 of loans, which would be $900 of M1. So if this bank wanted to, right, somebody could walk in and say, I want a loan. We could take off the excess reserves and we could turn that into a $900 loan. This money, when it's loaned, the money is gone. It's out of the bank, but it's owed to the bank, so it goes on the asset side still, right? So what all this means, right, is if the Fed can change the required reserves, they can change the amount that banks can loan. Look what happens when we change the reserve requirement to 20%. I'll do that transaction in red. So a 20% required reserves. Notice my liability side is the same, $1,000, But on the asset side, we get $200 of required reserves and then $800 that could potentially be loaned out. So notice that the blue bank, when the reserve requirement is 10%, they can loan 900. The red bank, when the reserve requirement is 20%, they can only loan 800. If the reserve requirement was to get smaller, if it was to be 5%, that's the green bank. Demand deposits don't change. On this side over here, 50 required reserves, 950 loans that come from those required reserves. So what we see, the general rule of thumb that we can create here is that if we change the reserve requirement, a lower reserve requirement leads to a larger supply of money because banks can give more loans if they have a lower reserve requirement. They keep less required reserves. That means more excess reserves. More excess reserves means more loans, and more loans means more money in the economy. Opposite is true as well. The Fed increases the reserve requirement. That leads to a decrease in the supply of money. So first thing that the Fed can do to change, and I know that that was like a long aside right there, but it's important for you to understand how those bank balance sheets work because you do see AP questions based on those. So they can change the reserve requirement to change the supply of money. The truth is that this is extremely rare. The Fed almost never does this, right? I'll talk more about that in a moment. The second thing that the Fed can do is that they can change the discount rate. So let's talk about that discount rate. One of the things that I mentioned before is like in the real world, this is, you know, you have, we go back to our balance sheet here, right? All day long at every bank in the United States, people are depositing money, people are spending money out of their checking account, people are paying back loans, people are walking in to get more loans. So all day long, these numbers are all changing, right? Demand deposits is going up, it's going down. Required reserves are going up and down with the demand deposits, right? Excess reserves are getting bigger, they're getting smaller. Maybe a lot of people one day come in for loans. Maybe one day a lot of people pay back loans. So what's happening is that, you know, these numbers are constantly changing. And at the end of the day, the bank needs to have its required reserves, its percentage, whether it's 10% or 5% or 20%, whatever the Fed sets as the percentage, they need that at the end of the day, right? But let's say that like on this one particular day, more people than normal came in for loans. And so the bank was making their loans and they were making their loans and they're like, oh yeah, we got money coming in. We got loans being paid back. We got deposits happening. And at the end of the day, the bank realizes that they're short on their required reserves. They're sitting at 9.8% and they're supposed to be at 10%, right? So what do? Well, that's where the discount rate comes back in. They can actually go to the Fed and they can say, hey, we're a little bit short. We don't have our 10% required reserves. We need to borrow $10 million so that we're at the 10% for our required reserves, right? And then the Fed can lend them that money, right? So when the Fed lends them money, they charge them interest, like when anybody lends money to anyone else. That interest rate is known as the discount rate. Now, the truth is, most big banks, they don't want to borrow money from the Fed. It doesn't look good. So if they're short on their reserves, what they're more likely to do is actually get a loan from another bank, and that's called the federal funds rate. The Fed keeps a really close track of the federal funds rate. That's what they use to kind of figure out what's going on. But it's called the federal funds rate because that's the rate that banks charge each other when they need to borrow funds to meet the Federal Reserve requirement, right? So that's the federal funds rate. Basically, the discount rate it's pretty symbolic. It's really what the Fed uses to let the public and to let businesses know what they're thinking and doing. So in general, right, if the Fed decides to lower the discount rate, a lower discount rate means that banks can borrow money from the Fed cheaply. So they're more likely to make loans because they know that they can always get money from the Fed to cover whatever loans that they make. So when the Fed lowers the discount rate, it should cause the supply of money to increase. So again, lower discount rate leads to a larger supply of money. And then the opposite is true as well, that when the Fed raises the discount rate, that leads to a decrease in the supply of money. Because when that interest rate goes up, banks don't want to have to pay that high interest rate if they're short on their reserves, so they're less likely to lend money out to customers. So the discount rate is the second tool that the Fed can use to shift the supply of money. Now, as I previously said, this is mostly symbolic. Typically, the Fed will shift the discount rate by about 1/4% in a month. It's called 25 basis points. 100 basis points is 1%. So 25 basis points is 1/4%. So usually the Fed, they meet once a month and they make an announcement as far as what they're doing to the discount rate. Usually they leave it alone. They don't move it up or down. But they might announce that if they think that there's some inflationary pressure, they might raise the discount rate by 25 basis points or 1/4%. Or if they think that there's like the economy is cooling down a little bit and if they're like, oh, it's not good, they might lower that interest rate by 1/4%, 25 basis points. Now, the next month, they probably leave it alone. But if they do the same thing like 3 months in a row or 2 months in a row, then people start to get a little bit nervous. If they're like, if the Fed raises interest rates 3 months in a row, then people are like, the Fed must be pretty worried about inflation. Now, if the Fed wants to send a really strong signal, like if the Fed is really worried about inflation or recession, they'll change that discount rate. They'll change it by 0.5%, 50 basis points. So you might see, like, let's say that the Fed was really worried about inflation. They might announce after their monthly meeting that the Fed is seeking to increase the discount rate by 0.5%. If the Fed is trying to increase rates by 0.5%, that tells everybody, all businesses, banks, consumers, tells everybody, the Fed, this group of economic experts, are super worried about inflation. And they're going to start cutting the money supply to try to drive up interest rates to stop inflation from getting out of control. That's what they're worried about. And that's like at a 50 basis points shift or 0.5%. Or if they were like really worried about the economy collapsing into a recession, they might move it by 0.5%. Like that would be a big move. Now, I'll tell you, in March of 2020, when I was teaching this economics course, and I had just gone over the discount rate and the Fed with my students, like probably around March, I would say like around March 10th, March 11th. I went over 2020. I went over the discount rate and the Fed and how all this works with my students, right? Now that week, the Fed had an emergency meeting to discuss interest rates, right? And it was pretty clear by that week in March that coronavirus was now out of containment in the United States, and it would be spreading. So by this, second week in March, the Fed meets to have an emergency meeting to talk about what to do about the economy. At the time, the discount rate was 1.75%. So I remember talking with my students, like we were trying to predict what we thought the Fed would do. If they would decrease interest rates by 0.5%, I thought maybe by 0.75%, by 75 basis points. That would be a pretty remarkable change. Turns out that that second week in March of 2020, the Federal Reserve cut the discount rate by 175 basis points, by 1.75%. They cut it all the way down to zero, which was pretty remarkable and was a major event. Now, the next day, I had a bunch of students come into school, and they came to find me in my classroom before first period started or before their classes started later in the day. And they came in and they walked in the door, and they're like, all of them had the same thing. They're like, Mr. Tweet, did you see what the Fed did? Right? And I was like, I know, this is super unbelievable. This is kind of unprecedented, and it's really scary. And the students understood it was really scary as well. In fact, they were like, my students were coming in and they were saying, I was talking to my parents, and my parents were thinking this coronavirus thing's not going to be a very big deal. And they're like, but the Fed cut interest rates by 1.75%. That means the Fed is freaked out. The Fed is looking at an economic disaster on their hands, and they're basically taking their one of their main tools that they use to try to fix the economy, and they're basically throwing everything they got at this problem right now. Right. So, it was very interesting because politically during that week, there was a lot of debate that was going back and forth about whether coronavirus is something to really be worried about or not. Right. And the president was saying things like, oh, it's a Democratic hoax, and the Democrats are using this to try to make me look bad. And so it wasn't really clear to citizens whether this thing was really that scary or not. But if you were following the Fed and if you understood macroeconomics, you knew that week, you knew that we had, whether it was going to be like a medical disaster or not, you knew we had an economic disaster on our hands, that the Fed made it absolutely clear that week when they cut those interest rates. Now, the other thing the Fed did that week was they lowered the reserve ratio to zero, right? They lowered it down all the way and said, banks, lend whatever you want to lend, because they knew that there was going to be massive economic turmoil, that the economy was going to grind to a halt. They knew that people were not going to be getting paychecks, that, that it was, all of a sudden that landlords weren't going to be getting rent paid to them. They knew that people were going to stop making their car payments when their salaries stopped coming in. The Fed knew that this was going to be a major disaster. And so they went to banks and said, we're going to lower the reserve ratio to 0%. So please keep making loans. Please keep making loans to keep aggregate demand as high as we can. And at the same time, they said, we will lend you whatever money you need at 0% so that you can continue making these loans, right? Because when the economy starts to collapse, banks get worried. People stop paying their mortgages. People stop paying their car payments. That's money that's not coming back into the banks, but they still owe those demand deposits to people. And if they don't have loans coming back in, how are they going to pay people their money when they come into the bank to get it, right? So banks end up holding on to excess reserves during economic crises. They end up hoarding their reserves because they're afraid people are going to come in to get their deposits. So that's where the Fed can step in, and the Fed can say, hey, we're going to lower the discount rate really low. So banks, if you need to borrow money, you can get it from us basically for free. They did the same thing during the Great Recession in 2008 and 2009. The Fed lowered the discount rate down to zero and told banks and said, look, we'll give you money. You pay us back when you can, zero interest. We just want you to keep making loans to people. We want you to keep trying to keep aggregate demand as high as we can until we can get through this economic crisis. But, right? This, like I said, almost never changes. I can only remember one time in my life where this has changed, right? That was a year ago during the pandemic when it started. This one here is mostly symbolic, except for when we have like an exceptional recession and banks actually do borrow this money from the Fed. This is almost entirely symbolic. So how does the Fed really change the money supply? Well, the answer is that the Fed they buy and they sell bonds. That these bonds right here are the key to monetary policy. So the Fed buys and sells bonds. Well, in order to remember what the Fed does, we're going to say the Fed, The Fed buys big and the Fed sells small. So you got a little alliteration there to help you, this mnemonic device to help you remember what the Fed does. That when the Fed wants to make the money supply bigger, they buy bonds. When the Fed wants to make the money supply smaller, they sell bonds. Okay? So let me show you how this works. This is kind of the last thing we'll do today. I'm going to move you guys over real quick so we can see what's going on over here. All right. So what I've got here for you guys, this is the circular flow diagram from Unit 4. This is basically a representation of the entire economy. We've got firms, we've got the government, we've got consumers here. Remember that consumers take their resources to the factor market and they sell them to businesses, that firms use those resources to make products which are sold to consumers, and that this cycle continually cycles one way. The other way, we have money flowing, right? Because in order to get you to sell your labor, businesses have to give you money. In order for you to get products, you have to give them money. So what we have are resources and products flow one way and money flows the other way in our circular flow model or diagram. Now, if the Fed thinks that the economy is in like a recession, basically that means we're not buying and selling enough products, so that this needs to speed up. Well, to speed this up, right, in order to get this outer black arrow to go faster, the inner money arrows have to go faster. So if the Fed thinks we're in a recession, the solution is to put more money into the economy. Again, when the Fed increases the money supply, interest rates fall down. When those interest rates fall down, it leads to more people buying these aggregate demand things up here. It closes that gap. So if the Fed sees that we have an economy that's going too slow, the solution is to put money into the economy. They want M1 going into the economy. So how does the Fed do that? How do they put M1 into the economy? Well, it would be nice if they would just give the M1 to Mr. Sweet. Like, I would love that, right? They could be like, oh yeah, we need to increase the money supply by 500 billion. Like, all right, Mr. Tweet, you and 500 of your friends each get $1 billion. You just got to promise you're going to spend it. That would be awesome. I would love that. But that's not how it works. When the Fed wants to put M1 into the economy, they want to do it fairly. So that means that if they're going to put M1 in, they need to take something out of equivalent value. What they take out are bonds. So what the Fed does, right? The Fed basically has a pile of like they get to create M1. So the Fed has an unlimited supply of M1, and then they have a portfolio of bonds that they hold on to. So the Fed's got M1 in bonds. When they want to increase the money supply, the Fed just starts selling it starts buying bonds from the economy. So the Fed basically takes their money, they go to the bond market, and the bond market is just like the stock market. It's it's an online exchange where people are matched up or whatever. Although the Fed has their own brokers, and I think they mostly deal with massive investment banks, and they're really buying millions of dollars of bonds at a time or selling millions of dollars of bonds. But in order for us to kind of understand it, you can think of it like this. That the Fed, if they wanted to put, let's say they wanted to add $5,000 to the economy, that all the Fed needs to do is they just find somebody who's selling a bond, and the Fed just goes, we'll buy that bond. And the Fed reaches into their pocket and takes $5,000 from outside the economy and puts it in. And they take the bond out of the economy and they put it in their portfolio or in their back pocket, and they just sit on that bond. So that now what's happened in the economy is there's $5,000 more of M1, there's $5,000 less of interest earning assets. But it balances, so the Fed is not playing favorites, they're not giving money, they're just trading money for bonds. But the amount of money in the economy has increased, which should lead to more aggregate demand, closing that recessionary gap. If there's an inflationary gap, they do just the opposite. If this thing is spinning too fast, if the economy is too hot, You just pull some money out and it won't spin as fast anymore. So they take money out. So if they wanted to take some money out of the economy, right? If they want M1 coming out, then what's got to go the other way? Bonds. So they take some of these bonds that they've been holding on to in their portfolio, they take these bonds and then they just sell them into the economy, right? They go to the bond market, and if they wanted to pull 5,000 out of the economy, they would just take one of their $5,000 bonds and they would just go to the bond market and say like, hey, anybody want to buy a bond? I've got one for $5,000 here. And when somebody says, oh, I'll take that bond, they give the bond to the person and they take the $5,000 out of the economy and stick it in their savings, their bank, their vault, whatever you want to call it, right? Into their pot, which is separate from the rest of the economy. That's how the Fed really changes the money supply, right? Sometimes it's referred to as like quantitative easing, where they're buying and selling bonds to change the money supply in the economy. So that's what I have for you guys today. I know it was a lot. Next time we're going to go over that packet together. So if you guys have any questions, feel free to